My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. I absolutely love this series. I love interacting with all of you and seeing how different individuals are investing all across the globe. I created this channel to help inspire and educate new investors. When I created this channel back in 2019, it was really a slow process. Not a lot of people watched the channel. I was still figuring out how to make YouTube videos, focusing on increasing the quality of every single video. It wasn't until 2020 where the channel really started to grow. I truly appreciate everyone that has supported the channel and helped the channel grow to where it is today. I know that there's channels out there that are growing 10 times as fast as the channel here. I truly appreciate every single one of you. Thank you so much. I don't have anything to sell to you. I'm not selling a course. I have a day job where I make all of my money. I have real estate. I don't have to sell you anything. If you want to buy merch, that's something kind of different. I feel like that's a little bit different. But when in terms of like selling a course or anything like that, or affiliate marketing or selling like sponsorships, like I don't have any motive to do that. I want to help inspire and educate new investors. And that's why I created the channel to begin with. At the beginning of 2020, we didn't even have 1,000 subscribers. Now ending the year, we have 20,000 subscribers. Thank you all so much. In today's Review My Pie, we're going to review 4 subscriber portfolios. The first is going to be from a 22-year-old here in the United States. The second is from a 21-year-old, also in the United States, a 32-year-old in the United States, and the last portfolio here, a 41-year-old from Germany. As always, everybody, I do not pre-record or script what I'm going to say. I'm looking at the portfolios for the very first time. And as always, everybody, I'm not a financial advisor. Please do not take what I'm saying as professional financial advice. This is just merely for your entertainment. I absolutely love this series. I am so excited for today's video. It's got me feeling like this. The first portfolio is from Jacob. Jacob writes, "Hey Jake, I'm a 22-year-old college student about a year away from graduation. As a result, the portfolio isn't very large and I'm only able to add roughly $50 to $100 a week currently, but plan to bump that number up to somewhere around $500 to $600 once I start my career soon." Wow, that's a huge bump. That's great. "I really don't like the idea of working a 40-hour week for the next 40 plus years and plan on living frugally and investing heavily so I can retire and live off the dividend as early as possible. I've tried to focus heavily on quality, growth dividend stocks rather than focusing on a current high yield. Any feedback would be greatly appreciated." I think this is a really great goal, especially here in 2020 where a lot of companies have been forced to cut their dividend simply because cash flow from these organizations has really come down, has come under pressure. The Fed has added a lot of liquidity into the market here, but in reality, a lot of companies have been faced with tough challenges. And what we've seen in 2020 is a lot of companies that really had great balance sheets, had a sustainable dividend, not only came out of this very well, but actually going into 2021 are going to be positioned much stronger than they were going into 2020. So let's take a look at your portfolio. Your portfolio is up 118% over the last 5 years. That is huge. You have 31 holdings, you have just under a 2.5 dividend yield and a 0 expense ratio. So you don't have any ETFs in here. Let's see what you have in here and how you have your portfolio set up. So you have the highest allocation set up to consumer staples and consumer discretionary. Okay, that's great. You also have 15% into the technology sector, 14 in financials, 10 in healthcare, 8 in utilities, 8 in industrials, 7 in the communication sector, 2 in real estate, and 2 in materials and 2 in energy. Okay, this is a very well diversified portfolio. And when it comes to the overall allocation, I think what's important is to understand your time horizon. I shared a video on this a few weeks ago on optimizing your portfolio based off of your time horizon. Looking at what you have right now can go really, it's flexible, right? You have really a great performance over the last 5 years. You have a low dividend in terms of, 2 to 2.5% is actually really strong. It's higher than the S&P 500, but we know it's so interesting where I'm really excited to look into this portfolio. You're totally crushing the S&P 500. in terms of the last 5-year performance. And this is not including the reinvestment of dividends. So this, you're absolutely destroying the S&P 500. You have a higher starting yield with 2.4%, and you're almost double what the S&P 500 has done over the last 5 years. This is a spectacular portfolio in terms of the numbers that you have here. Let's take a look and see what you have under the hood in your individual slices. In your consumer staples, you're up over 74%. This is massive. You got Pepsi, Procter & Gamble, Walmart, and Coca-Cola. This is absolutely great. So Pepsi, you have the highest, Procter & Gamble. You have a good mix here of, it's more skewed towards growth, as you mentioned in your email, and I think this is a great approach. You also have Coca-Cola in here. Coca-Cola is not growing as quickly as a Pepsi, a Procter & Gamble, and a Walmart, but it has, it has right around a 3% dividend yield, whereas a Procter & Gamble has a little over a 2%, Walmart just under a 1%, and Pepsi, it's averaged between 2.7 and 3 point something here in 2020. This is a really strong portfolio. These companies are sleep well at night companies. These companies are going to be around for generations. Great slice. In your consumer discretionary slice, you're up 79%, really high. You got Starbucks, great company, Disney, McDonald's, Home Depot, Nike, Lowe's, Leggett & Platt. These are all really great companies. You have some dividend aristocrats in here. You have some really high quality companies. When it comes to Disney, Disney is a very long-term play. Disney is not I really believe in Disney, but I don't think you're going to see the dividend income, cash flow from Disney for 5-10 years. With your time horizon, I think it still belongs in the portfolio. Depending on if you're looking at a 10, 20, or 30 time horizon, if you're looking between 10 and 20, maybe you reduce Disney, maybe not. I think it really comes down to, what you're looking to do, but every single one of these companies in here, these are absolutely great. This is probably, if I were to take a guess, your lowest yielding after your technology slice with a 1.5%. Really great portfolio slice. Your technology slice is up 300%. Holy shit. You got two in here. You got Microsoft and you got Apple, two really great companies, 57 and 43. Sure, why not? Both really high quality companies. I can't, in my opinion, these are, I think Apple is at a $2 trillion market cap. I mean, just absolutely great companies. Financials at 14%, 163 in financials. Let's see. You got Visa. Okay, you could put Visa in financials. Financials, technology. MasterCard, JP Morgan, and Aflac. These are all really great companies. Let's take a look at your healthcare. What do you got in healthcare? You got Johnson & Johnson and you got AbbVie. Absolutely amazing. These are great companies. If you wanted to expand this slice, maybe down the road, it's something that you could take a look at. There's other companies that I like, including Stryker and Medtronic, for example. Those are a few that I really like in the healthcare sector. All right, now let's take a look at your utility slice. In your utilities, you're up 113%. A lot of times when people think about utilities, they think of slow growers. So you absolutely have some growth utilities in here. I'm betting that you probably have like a Nexter Energy or something in here, or maybe a water utility. Let's take a look. You got Nexter Energy, you got Duke, and you got the sector-specific utility ETF from Vanguard VPU. This is really great. I really like the VPU in here. You could go with a Southern company. You could go with a Consolidated Edison, more of these traditional, 4.5% yielding utilities. But you said you want to focus more on growth. This is a great allocation here with Nexter Energy and with Duke. These are great companies. Let's see what you have here in your industrials. Your industrials also at 8%. You got 3M, you got Waste Management, and you got Caterpillar. These are great companies. 3M, Waste Management, and Caterpillar. Another one that you could take a look at that I personally really like is Lockheed Martin. Now, a lot of times people look at, these defense companies or contractor companies with the government, or aerospace companies, and they look at these companies and they get a little bit concerned when they see a change in the government powers here in the U.S. I think regardless, Republican or Democrat, you're going to see growth in Lockheed Martin. One to maybe take a look at, but as it stands here, these are great companies. They're not going anywhere. And with Caterpillar is really interesting, especially with the growth in China. I think, here in the US, it's still growing. really the growth for Caterpillar is in emerging markets, in international, in countries in Asia, for example. So it'll be really interesting to see how it works and how it progresses. And when you build a dividend growth portfolio, you build it for the idea that you're going to hold this for generations, and you don't want to just look in the next 4 years, right? In the next 4 years of the current presidency, what it's going to look like, but what is it going to look like 10, 20, 30 years down the road? And I think Caterpillar, I think Waste Management, and I think 3M are going to be great industrials going forward. Let's take a look at your communication slice. You got Verizon and you got AT&T. Both really great, really stable, strong companies. Let's see what you have in your real estate slice. You got Realty Income. I really like Realty Income. You only have 2% allocated here. I think, you mentioned you want to focus on growth. I think this is a missed opportunity if you just have one in here. If you're just going to have one company in this slice, what I would encourage you to maybe consider is, Realty Income is a great retail-oriented REIT. If you just want to have one, maybe you go with an ETF, VNQ, USRT, these type of really low fee REITs are really good, REIT ETFs. If you want to look at other hyper growth REITs, you could look at cell towers. I really like AMT. You could look in industrial REITs. I really like Prologis. I really like Public Storage. That's not such a hyper growth like an AMT. I also like data center REITs in DLR, for example. Something to take a look at. So far, I think your REIT slice needs a little bit of attention, or you could consider reevaluating how you want to set up your REIT slice. I think just having one retail REIT is maybe a missed opportunity, in my opinion. Let's take a look at your materials. In your materials, you have the Vanguard VAW. I think it's absolutely fine. If you wanted to look into other individual companies that are growth oriented, you could look at PPG, you could look at Ecolab, ticker symbol ECL. There's a few other really hyper growth ones, but I think most people would be better off going with a industry specific ETF, for example, here like VAW, because a lot of consumers, retail investors don't really understand B2B material companies. All right, let's take a look at your last slice, your energy slice. The two that you have in here are Chevron and ExxonMobil. I think both of these are great. All right, well, Jacob, I think your portfolio is spot on. I think this is a rock solid portfolio. I think this is a portfolio that you could go to bed at night sleeping very well, knowing that, if the market goes down 20, 30% in a correction, that you can feel very confident averaging down and buying more into your portfolio. That's what I love about these type of portfolios. The companies that you're investing in, these companies are going to be around for generations to come. Thank you so much for sending over your portfolio. All right, let's take a look at the second portfolio. The second portfolio is from Brevin. Brevin writes, Jake, first off, I love the heck out of your videos. No nonsense and great information. Keep up the great work. Thank you so much, man. I really appreciate you saying that. Just a little bit more about my situation for context. I'm 21 and started investing in Robinhood in July last year. I invested $2,000 over the last 12 months, mainly in SPYG, FTEC, and Microsoft. Really strong ETF in SPYG. Great. Okay, great. Once I started watching your channel, I opened an M1 account because I love the simplicity of auto investing and fractional shares. I've been investing $100 a month. I'm still finishing school, so I only work summers, but it's a sales job and pays fairly well. I have the ability to contribute more, but I'm hesitant because I'm not quite sure how much I should be diversifying at this point. I'm very open to risk because my investing horizon is 15 years, although I love the FIRE movement and would love to retire in my late 30s. Should I be more focused on growth stocks because I'm so young? I love the idea of having enough dividends to cover my living expenses, but I'm not sure how to approach it. I would love it if you could take a look at my M1 portfolio and give me some advice. The fact that you're in a sales job is a great way to fund your portfolio. As we know, if you want to retire early, there's a few things that you need to focus on. You need to focus on cutting your consumer debt. If you're paying somebody else, you're not paying yourself. You need to focus on cutting your expenses, right? If you're overpaying for certain things, how can you bring your costs down? And then the third thing is, how can you make more money? I also am in a sales job. I am paid a base salary plus a commission salary on a monthly basis. So based off of the work that I put in, I get out more based off of the effort that I put in there. And so that's what I love about jobs like a sales job, because especially sales jobs that are not capped on their commissions, because you can make so much money, and that money you can take and you can put into your portfolio and really accelerate the snowball effect of your dividend portfolio. When it comes to your time horizon, I would recommend taking a look at a previous video that I created called the Dividend Starter Pack, based off of a 10, 20, 30, and 40-year time horizon, and what kind of investments I look for when investing for FIRE, for a dividend growth strategy. I'd recommend you take a look at that video. I really go more into detail when it comes to answering that specific question. Let's take a look at your portfolio. You're up 202%. Holy cow. Wowzers. You got 11 holdings in here. You got 2.8% dividend yield, and you have an expense ratio, very, very small expense ratio. Let's see what you got in here. You got SPYD. Okay, really good high dividend ETF. I'll touch on that in just a second, but let's go through the rest of them that you got in here. You got Microsoft, you got AT&T, you got Disney, Nvidia, McDonald's, 3M, Coca-Cola, Waste Management, Johnson & Johnson, and Cisco. These are all really, really great companies. So you are off to a great start. This is absolutely great. So now, after you've watched that other video in terms of the time horizons and how to optimize your portfolio based off of your time horizon, I think it's going to answer a lot of those questions. When it comes to FIRE, that's the first question that you have to answer. When are you planning on living off of the dividend income from your portfolio? Now, not everybody knows, to a T exactly when that's going to be. For my wife and I, we have a moving target goal. We're looking between 8 and 10 years, right? There's things that could happen right along the way that could accelerate it, or, they could come in the way. So you have to understand that it is a moving target, and you can only really just use your best guess. That's really been my wife and I's experience. When it comes to your portfolio, you have a lot of great companies in here. SPYD, I absolutely love SPYD. I don't invest into it today. The reason why I don't invest into SPYD today is because the allocation that it has to real estate investment trusts. You're taxed very differently when it comes to REITs. Because REITs are taxed differently than, for example, a Microsoft or an AT&T, I prefer to invest more into qualified dividends, because then I'm paying less taxes along the way. Once I get closer to retirement, 1 or 2 years before, I'm then going to be transitioning more into real estate investment trusts. And because by doing that, I'm going to optimize the taxes. So SPYD, great ETF, but something to consider. It has a high dividend. Yeah, the last time I checked, it was like 6%. It's just incredibly high. But you have to understand there's a lot of exposure to REITs. It's very different than a SCHD from Schwab or VYM from Vanguard. These ETFs that I invest into my M1 portfolio, they have zero exposure to REITs, and so I'm paying the lowest capital gains tax on these ETFs. Very, very important to understand, and to understand that aspect of the taxes when it comes to your dividends. In terms of your other holdings in here, you got Microsoft, you got AT&T. It's a good blend. It's a good mix. That's one of the things that I love about M1 Finance is you're going to take that high yield, that high current yield of AT&T and 3M and Coca-Cola, and you're going to invest it back into Microsoft, into Waste Management, these lower, starting yielding companies, and it's going to snowball your portfolio even more. In terms of your portfolio, I think you have a strong portfolio. And when it comes to your goal, I think you're going to need to make a few tweaks in terms of the allocation of how you have each of the holdings set up. For example, if you have a 15-year time horizon, a 2.8% dividend yield is a very healthy, strong dividend yield. Once again, you have to kind of understand what the tax is, right? Like that is something to consider. That range of around 2.5 to 3.5% is kind of that sweet spot if you have a 15-year time horizon. So for example, if you had a 10-year time horizon, you would want to make sure that your higher yielding companies in here make up a larger percentage of your portfolio. That being AT&T, Johnson & Johnson, Coca-Cola, 3M, etc. And then you would want to lower Microsoft, Disney, and Nvidia. Now, if you had a 30-year time horizon, then you would want to increase your Microsoft, you want to increase your Waste Management, your McDonald's, your Nvidia, your Disney. Now, it all comes down to your time horizon. I hope that this helps. Once again, you're going to get a lot more context from that other video in terms of investing based off of your time horizon. Thank you so much for sending over your portfolio. All right, let's take a look at the third portfolio here. The third portfolio is from Danny. Danny writes, "Hey Jake, thank you so much for taking the time out to review my portfolio. I have to say, I love all of your videos and inspire me to start my own portfolio. Keep up the great work. I'll be sure to continue smashing that like button for you." Thank you so much, Danny. I appreciate the support. I am currently 32 years old and recently started investing into my portfolio. Started February of 2020. Oh man, right before the crash. I hope you've been dollar cost averaging ever since. I have a mixture of both growth stocks and dividend stocks. My goal is to retire around 50 if possible. So you have just under a 20-year time horizon, okay? With an annual dividend income of at least 50K, 18 more years to go. I know my overall current dividend yield may be on the lower side, 1.7%, but most of my holdings have close to, if not double-digit dividend growth rate, with the exception of a few. I currently have about 11,000 invested. I add $300 a week. I'm about to increase it to $500 a week. That's awesome, man. If possible, can you take a look at my portfolio and let me know what you think? What would you change, if any? And if I'm on the right path to earn $50,000 in annual dividends from my current portfolio. All right, man. Well, this is a great goal. So the thing that I love about what you're saying here is you're starting with that goal of $50,000. That is exactly what my wife and I did, right? So we don't know necessarily exactly what our expenses are going to be in 10, 20 years. What we do know is kind of roughly right around what we need. And whenever you're planning your future and planning to live off of your portfolio, it is always best, always. I'm talking to you, everybody out there that is in their 20s and thinking about building a dividend portfolio. The best thing that you can do is look into the future and think, what is the ideal situation? In 10 years, 20 years, 30 years, I want to have X amount of money so that I can live off of the portfolio. And then what you do is you have that goal, you have that plan, and you work backwards. And you think, okay, well, my goal is to generate 50K a year in dividends. What do I need to do to generate that in cash flow? Okay. And then you start building your portfolio. Then you start cutting your costs. Then you start factoring in, okay, how much do I have to invest? All of that fun, nerdy stuff that we as dividend investors love to do. All right, Danny, let's take a look at your portfolio. You're up about 55% over the last 5 years. You have just under a 2% dividend yield. This is very in line with the S&P 500, right? If you were to just buy the S&P 500, you would pretty much be getting the exact same results over the last 5 years. Let's take a look and see what you have in your portfolio. You have the highest allocation set to technology. You have growth ETFs. You have industrials, consumer discretionary, information technology. For me, that's kind of the same as tech. So you got about 35-ish% in technology. You got healthcare, you got consumer staples, energy, communication services, REITs, industrial, aerospace, financials, transportation, and miscellaneous. Okay, let's take a look at this. So you've engineered your portfolio, okay? And now you have your goal, you have your plan of $50,000 in annual cash flow. Let's take a look at your first slice here, your tech slice. It's at 29%. You got NVIDIA, you got Microsoft, you got Apple, MasterCard, Visa, Amazon, and Google. Okay, so with this slice, you're not going to be able to live off of the dividend income from this slice in 18 years. It's not going to happen. I'm sorry. But that doesn't mean that it's not a good investment strategy, right? You could invest into tech and you could invest into this in a growth strategy, and then you could transition, you could liquidate, you could sell the shares, and then you could transition into a higher yielding dividend stock. That could work absolutely, right? A lot of people ask me on the channel here, hey Jake, what if I just invested everything into growth and then sold off and then bought higher dividend stocks? That could absolutely work. That could work very, very well for a lot of people. On my channel, I don't really talk a lot about that because that's not my goal. My goal is to buy and hold and to never sell. But I mean, it could work, right? You buy NVIDIA, you buy Microsoft, in 18 years you sell it, and then you buy Coca-Cola or you buy, whatever. That strategy could work. And that's the approach that what I'm assuming you're taking with this. If you want to invest and in 18 years live off your portfolio and never sell your shares, I'm telling you right now, you're not going to meet that goal with this slice. This slice is not going to help you meet that goal. So you have to ask the question, what do you prefer? Do you want the slow and steady approach? Do you want to slowly build up your portfolio and have it compound and never sell your shares? Or do you want to invest in companies like Visa and Nvidia over the next 18 years with the intention to sell them and then buy other companies? That's the question that you have to ask. And now it's not a all or nothing, right? You could do a mixture. You could do a little bit of both. It doesn't have to be all or nothing. But that is really the question that you have to answer for yourself. And I'm here to say, in my opinion, both approaches could work. Both approaches could work. Now, let's take a look at your growth ETF slice. With your growth ETF slice, you got VGT, you got ARK, you got some really hyper growth ones. I think this is fine. But once again, as I mentioned, you're not going to live off of the dividends from this slice. So you would then be taking the other approach where you're investing into growth, and then you would rebalance, transition from growth to current income, which could also work. So it's very, very important that you understand that. Now let's take a look at your industrials. Industrials, you got APD. This is a materials, but you got Waste Management, you got Caterpillar, and you got Sherwin-Williams. So this is an industrials / materials slice. This slice, yes, it could work. You're on the right track, but 18 years, if you want to live off of this slice or have this slice, pay for your living expenses for with its dividend, you're going to have to invest a lot of money. With a 1.7% dividend yield with an 18-year time horizon, you're either going to have to find other holdings like 3M that have over a 3% dividend yield for example, and you're going to have to build up that position, or you're going to have to make a lot of money and invest a lot of money into your portfolio if your goal is to buy and hold. Okay, very, very important. I would also encourage you to also take a look at that other video that I made when it comes to your investing time horizon with a 10, 20, 30, and 40 year. I created the video a couple of weeks ago. You can check it out. That would help answer a lot of those questions. But when it comes to this, 18 years, you're going to have to invest a lot of money on a monthly basis to reach your goal of $50,000 in annual cash flow. Let's take a look at your consumer discretionary. This is good. Home Depot, Lowe's, and McDonald's. This could work well. Another one that I like is Target. Target is pretty good, though it's run up so fast here in 2020. It's another good one that I like. But these are really great. Information technology, you got Broadcom and you got Texas Instruments. Okay, these two are not necessarily, they don't fall necessarily in the same bucket as a Nvidia, a MasterCard, a Visa. These holdings you could hold and slowly grow and build, and not necessarily have to sell in 18 years to live off the cash flow. This slice here is more in line with how I have my portfolio set up, where you buy and you hold and you grow up the position. You're not planning on selling in 18 years. Okay, so very, very different from the other technology slices in the portfolio. With healthcare, you have a 2% dividend yield. You got AbbVie, you got United Healthcare, you got Johnson & Johnson, and you have a few really hyper growth pharmaceuticals in here. These are just insane. Like, I think this is one of the larger holdings in the ARK Invest ETF. Really, really massive growth. I mean, as you can see, over 340% in the last 5 years. Insane. Yeah, these are also really great. It's kind of a balance here of, growth and dividend. Consumer staples, you got Costco, you got Pepsi, and you got Clorox. Yeah, these are really good companies. I think you have a good dividend yield of 2.8%. This is more on track with what I talk about on my channel, where you buy and you hold, and you never sell. And in 18 years, you're going to live off of the cash flow. So then what you would do is, in 18 years, you would take the holdings from the technology slice and the growth slice, you would rebalance out of those, and then you would purchase holdings like, for example, in your consumer staple slice. That's how you would get the $50,000 in annual cash flow. Okay, very, very important. Energy, you got Nextra Energy. This is fine. This is another one in 18 years. Another few that you could look at. I really like Duke, ticker symbol DUK. I really like Southern Company, ticker SO. These are really great dividend utilities, for example. Energy, utility companies. Communication services, you got Disney, AT&T, and you got Verizon. If your time horizon is 18 years, I would encourage you, if you don't plan on ever selling them, if you don't want to sell them, I would lower Disney. I would increase AT&T and Verizon. That's what I would do personally. REITs you got in here, you got DLR, you got Realty Income, and AMT. These are really good. I think this is fine with your time horizon. I think these are good. And the allocation, yeah, sure, why not? I mean, you could mix these up a little bit, but I think overall they're fine for an 18-year time horizon. You got industrials, aerospace, Lockheed Martin, great. Yeah, and this is fine. This is one of those, again, that you don't sell, right? You build up the position over the next 18 years, and this is going to be cash flowing like crazy in 18 years. Financials, you got BlackRock, you got JP Morgan. Yeah, these are more your traditional dividend companies that you wouldn't sell. Transportation, you got UPS and you got Union Pacific. Both really, really great. UPS is one of the highest performing companies in 2020 in my portfolio. It's absolutely crazy. You can see that it's just jumped up like crazy here in 2020. Great. And what do you got here? 1%. You got Altria Group. Yeah, Altria Group. Exactly. Right. It's a high dividend company, right? It's got over a 7% dividend. It's, it's a great dividend company. Regardless of what you feel about the company itself and the products, it is a very, very shareholder-friendly or dividend shareholder-friendly company. In terms of total returns with the high dividend, it hasn't performed as well as the S&P 500 in the last couple of years, but over the last 20 or 30 years, it's one of the highest performing companies in the United States. Really, really cool. But just as of late, it's been it's been a little bit behind the S&P 500. All right. So once again, I think your portfolio, you really have to ask the question, what's your goal, right? You're kind of taking a hybrid approach where if your goal is to generate 50K in annual cash flow in 18 years, it's going in the current state of the portfolio to reach your goal, you're going to have to liquidate your shares, or at least part of your portfolio, and then rebalance. I think that approach could work very well. It's personally not the approach that I take, but it could work very well. Once again, thank you so much for sending over your portfolio. All right, let's take a look at the last portfolio. The last portfolio is from Fabian. Fabian writes, "Hi Jake, I like your channel. Thank you so much for all the good stuff." Thank you, Fabian. I really appreciate it. I'm 41 years old and plan to retire in 20 years, but since my job situation is currently kind of insecure, I want to be able to dip into some dividends earlier, hence the high yielders. Now the growth stocks perform so well, I've been tempted to give my portfolio a little bit of a growth kick, though, and moving on, I plan to focus more on my growth ETS funds as well as low yielding dividend stocks. Don't have any individual dividend stocks that yield less than 1.5% though. I currently invest around $1,500 per month. That's great. 50% of the holdings are in an American account, the other 50% in a European one. The REITs are in my Roth IRA. The mutual fund is in my 401k. The holdings in the graph are ordered by sector. I also separated the ETFs mutual funds from the individual stocks. Thanks again. All the best wishes. Thank you, Fabian, for sending over your portfolio. It's so cool to see that you're following the channel all the way over from Germany. For those of you that have followed the channel, you know that I actually lived about 10 years in Germany. The majority of my time I spent in southern Germany and Bavaria. I also lived in Frankfurt. I did my master's. I completed a master's in southern Bavaria. I absolutely love Germany. My wife and I, we just ordered some German chocolate and Lebkuchen from Germany. Absolutely love it. My wife is from northern Germany, and we're down here in Texas. So very cool. All right, this is so cool. Let's take a look at your portfolio. I'm going to start with Bristol Myers, and I'm going to go clockwise through here. You got also Johnson & Johnson. I can never pronounce this. Roche. I used to work with them when I lived in Germany, so I should be able to pronounce them. You got United Healthcare. You got Pfizer. You got Novo Nordisk. You got Unilever, great, Pepsi, Altria Group, Mowi. I'm not familiar with Mowi. Lowe's, 3M, Caterpillar, Lockheed Martin, Union Pacific, Allianz. That was also another big account in Germany that I used to work with. Bank of Nova Scotia, really good bank. Discover Financial Services, okay. You got Ameriprise, you got Broadcom, good. You got Taiwan Semiconductor. This is a really, really big one here now with 5G, and really, really big opportunity there. You got Cisco, right? Great. Oh, you got American Tower in there. It's a good read. Medical Properties also good. Stag also good. EPR, man, I hope that they can survive here in 2020, man. I used to have EPR in my portfolio just simply with the pandemic, and it's very entertainment and discretionary focused, on movie theaters and stuff like that. Gazprom, okay, Red Electrica, Nexter Energy, AT&T, T. Rowe Price. T. Rowe Price is it's a growth fund. It's not the actual T. Rowe Price. So you got a growth fund in there. You got Horizons Marijuana. Okay, cool. At 2%. You got the JP Morgan International Growth ETF. You got the ARK Innovation ETF at 2%. And you got gold and you got treasuries and you have cash as well. This is a very well diversified portfolio. My initial thoughts are you are focusing on really established companies. The companies that I really like seeing in here, I like seeing Johnson & Johnson. I like seeing Pepsi. Unilever is great. Caterpillar, 3M. Cisco is another good one. You have a few REITs in here. I like the fact that you don't have a lot of exposure to REITs. I think it's just less than 10% in REITs, which is really good. You have really good sector allocation. You're not too heavy in banks, insurance. You have it really well balanced. The one thing that I would encourage you to take a look at is the mutual funds. Really, I can't see the expense ratio. The only thing that I could really see as being maybe a potential red flag are the expenses. I don't know what the expenses are with the T. Rowe Price Large Cap Growth Fund, the Marijuana Fund, or the International Growth ETF. I know the ARK ETF is less than 1%, but I mean ARK is kind of a unique one. When it comes to your overall portfolio, those are the things that I'm looking at. Make sure you're keeping your expenses low. You have some really high quality companies in here. Also, when it comes to your portfolio, you have a lot of international companies in here. Make sure that you're not overpaying in taxes, right? International taxes, something that not a lot of people recognize or look into, but when you're holding certain companies from a different country, the country itself will actually charge a fee in international tax. So something to be aware of. I know that's the case here in the United States, right? If we invest into certain companies in Switzerland or other parts of Europe or the world, there's an international tax. So something to be aware of. But I think, Fabian, this is a really strong portfolio. I love that you have it balanced between the different sectors. You're very well diversified. Thank you so much for sending over your portfolio. Viele Grüße aus Texas. If you would like me to review your portfolio in a future video, you can send me an email that's in the description below. Your goals, what you're looking to achieve, your time horizon, your age, where you're currently at, and I'd be happy to review in a future video. Thank you so much, everybody, for watching the video. If you're new to the channel, I'd invite you to subscribe. Check out the merch site in the description below. And if you liked today's video, give me a thumbs up. And I'll catch you, everybody, in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.